what the Fed does for short-term rates has some effect on long-term rates. It's ultimately market-based. So there's a scenario I've seen that even if they cut, rates can start going up because a lot of those have already been priced into our rate sheets already, like on the secondary market. So if they don't cut as much because they don't know them to do 25 or 50 basis points, there's a scenario rates should go up. So I always say, look, if the numbers make sense today, I just did a lot of VA interest rate reduction loans for some of my VA borrowers, so we had incentives. So if the numbers make sense today, do it. Like waiting doesn't really benefit you that much.
My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and our guest today is going to be able to give you lots of insights into different ways to approach vacation property financing and purchasing. Emmett Dempsey has been a mortgage broker for more than 2 decades and is the owner of Treasure Coast Mortgage in Port St. Lucie, Florida, a hotbed of vacation properties. He and his wife, Cheryl, have bought and financed multiple Airbnbs. Emmett, welcome to the show.
Thank you for having me.
I'm glad to have you on. A lot of people, especially in the short-term vacation rental, these investors, one of the biggest problems they face or one of the bigger issues they face is getting financing in place for their homes, the investments that they're making. So today we're going to have you on. We're going to talk a little bit about what you need to do on the lending side, what kind of programs are available to people, and how they can really maximize their growth and their returns by utilizing debt.
Okay. Well, there's a few avenues that you can take. So we can discuss all those avenues, whether you either house hack or you buy an investment property.
What is house hacking?
House hacking is essentially you buy a property owner occupied and you live in it for a year, and then you buy another one that you live to live in. Obviously, it's best when you're single. You not really have big roots of family and whatnot. But essentially, instead of putting down 20-25%, you're putting down 3 to 5% on your owner occupied, and you're turning your old property into a rental. So if you're strategic about it, you can acquire property for little out of pocket, versus putting on 20-25%.
And that's like some kind of a conventional type loan?
No, you can do it FHA, VA. For me, I'm a veteran. I have a VA loan. A VA is no money down, very good interest rates. And if you can also buy between 1 to 4 units, so you can buy multifamily property, live in one, rent out the other 3. There's a lot of strategies that you can do about buying multifamily and doing house hacking.
Awesome. So what about the person, though, who's sitting there going, okay, I'm not single. I do already have my primary residence. I'm not going to move and keep doing that. By the way, I think that's a great play. I've seen so many people do that with the house hacking. I absolutely love that play. But the person who's sitting there as an entrepreneur, maybe they, can't get that conventional type financing. What kind of programs are available for those folks?
Well, ultimately, when I do an analysis, Robin, is that basically I can say, okay, let's try and go conventional. If it's absolutely out of the cards, then we can go what's called DSCR, debt service coverage ratio. So basically, I don't want to say it's a stated income loan, but it's a no income documentation loan, no DTI. The only qualifier is, does the property cash flow? So what'll happen is we send out the appraiser. They do what's called a 1007 report. They'll get what the rental comparables for long-term rents. That's one avenue. They look at long-term rent because the mentality for the lending industry is everything's a long-term rental. So that's number one. So, and there's other lenders that have used like AirDNA information for short-term rentals. What they want to know is, will this property cash flow? Ideally, at least 1 times the debt service, your principal, interest, taxes, insurance, or HOA. So that's how we've bought property. That's how I do a lot of loans that way. And we can do that all over the country because it's considered commercial. And you could take property in your LLC. You do a lot of the things that entrepreneurs want to do with a DSCR. And really the rate differential is really not that much compared to other investment properties. So it's a pretty good program.
Yeah. So what kind of premium are you talking about? Is it 50 basis points, 100 basis points?
I'd say so between 50 and 100, depending on the lender. And really the way that things have changed, even on conventional side, they've lost the appetite even for second homes. Yeah, because a lot of people don't know that the second home rules used to be the same as primary, but the second home rules made it more investment property. That was kind of that nice little switch that the FHFA did, and nobody really knew about it. But so the difference is on DSCR, because there's such a huge appetite for it, and even my major lenders, even like my UWM's the number one lender in the country, they want it, and like I get prospected by every lender in the country. Hey, you got your DSCR, I was like, I wish I had more investors that do it, so I would send you some more loans. But it's a very popular program because there's an appetite for it in the secondary market.
Yeah. So it's a popular program. So people are basically going through and getting building out a pro forma operating statement. You're saying that's coming from the appraiser in that stance? They're coming in looking at, do they take into account just the income, or do they look at all the expenses so they can really get to a true NOI?
They don't need to go that deep. So it's really for a single family house. And some of them will go up to 8 units. It's all about the cash flow. It's all about the top line cash flow. So what is this rent for versus what are the expenses? What is the debt service? They don't really care about the other expenses. They don't ask about it. All it's about is debt service. And I can surmise that just by the supply and demand, because we're still, by some estimates, over 4 million units underbuilt after 2008. That's why there's an appetite for it. I mean, if we had 2006 level of inventory and demand, it would be a different story. But I think the way demographics and inventory are right now, there's a huge demand for that product.
Yeah. So when you're looking at this, so they're not necessarily just looking at current income. They would look at projected income also. Is that what we're saying?
No, they're looking at does it rent for today? And does it rent for at least 1 times the debt service? And you can go below 1, not much more below 1. And they'll basically make you put more money down to account for that risk. But essentially it's usually 20% down. I have some that go to 15, but very few. And it's very credit sensitive. So credit is the way in. I can go down as low as 640, but obviously with a lot more money down. But it all depends on your situation. But it's still, you take it in your personal name. You can transfer the property into an LLC. But overall, it's really just a credit-based loan.
Okay. So Emmett, when you're looking at these loans, this loan type, so let's take into account like the short-term vacation renter. So he's looking at a property, but maybe it's not a short-term vacation rental right now, but he's going to use it for that. Will they take into account what they think they could get for the property, or does it have to be historical data to really show out that income stream?
Well, they'll use an alternative form. What underwriters like is third-party verification. So they like an appraiser to do the long-term rental analysis, number one. If we feel that that's not accurate about what it could rent for, they'll use an alternative form. I have some lenders that'll use AirDNA or another service that'll look at what that property in that neighborhood would rent for on a short-term rental space. So they'll use that figure as the debt service number.
Yeah, well, that makes sense because, a lot of people aren't going to have some of that rental history or, of course, maybe they've got some operating history, but it sounds like that does not matter. It's like they're not even looking at the historical operating expense. They just want to see the income side. Yeah. What kind of time period does that take? So if I'm an investor, I'm saying, okay, I'm going to start looking for my first vacation home. I really like this product that you're talking about. What is the time frame to get from the start to the finish on a product like that?
As soon as you're under contract, about 30 days. It's a standard loan process.
Yeah, so very simple. So people come in. Do they come to you, and can they get a pre-approval from you?
Yes. Yeah, they'll come to me, get a pre-approval, and I always run different scenarios based on your credit, how much capital you have. So we kind of look at a different range of purchase prices. Like here's this purchase price. I usually lay out 3 different ranges, from two extreme, one in the middle. It's like here's if you buy at this price, what it would be down, cash to close, payment, and things like that.
Yeah, so you get a good picture, you go, and then you get the loan underwritten, and then do you have I'm assuming multiple places that you can put that debt, multiple clients that goes to?
Yes, I do the pre-approval. Now, I'm a mortgage broker, so I'm a wholesaler. So I have multiple wholesale lenders that will actually fund the loans when the time comes, and I will decide which loan we go with based off the pricing as well as special guidelines. So for instance, if you're a first-time vacation buyer, certain lenders don't like that. So they won't take if you have no rental history. So I know which lenders that will. So knowing as much about you as I can, as early as I can, is very important.
Yeah. So somebody comes in, they give you their information, kind of look at your history. And it doesn't sound like it's something that can't be done. If I'm going into my first home, I can still come to you, but there's just a certain subset of lenders that are probably going to look at me versus the larger subset of lenders.
Yes.
But I come to you, I get my information, I go through the pre-approval process. I mean, honestly, it doesn't sound that different than just your conventional at that point. It sounds like you're going through the same processes. You're still getting an appraisal done, even though the appraisal will be a little bit different than your typical appraisal. And I should know that form, being an appraiser myself. But I do mostly commercial stuff, so I can't think of the residential form off the top of my head. But
It's a 1004.
there you go, the 1004.
There you go.
Yeah, I knew that.
Yeah, I would agree. It's pretty standardized. It's become so popular at so many of my investors. It used to be just a subset, like Angel Oak was one of the very first ones in there. There was like an offshoot of very satellite lender, but now your major lenders have an appetite for it, and I think they have another investor that ultimately buys it. But it's become very, very commercialized and very, very standardized.
So, I mean, you were talking about, it's like, did you say it was a 10% down type loan? Or did you say it varied? I can't recall.
Yes. So as the little down that I've seen on these kind of loans, 15%, I haven't personally closed it. Usually the pricing is so awful that it doesn't make sense. So ideal sweet spot's about 20 to 25% down.
Okay.
And it's for the investor that maybe has enough conventional loans. I think that it's 10 maximum you can have, or they have complicated income pictures that they can't qualify, or they can, but it would just be so egregious to get all their paperwork and all their LLC paperwork. It's just crazy the way documentation is. Even for your W-2 employees, it's pretty crazy these days. So
yeah, which as an entrepreneur, I mean, that's the tough thing. Most of the folks that are looking at these type of properties or being investors, you know, they're not getting this W-2 income. I'm an example of that. I'm an entrepreneur, always have been. If you go through my companies, you're going to be looking at, 6 sets of tax returns. You're going to be looking at so many different things that it's just convoluted and difficult. But on the other hand, I would be coming in myself and have something closer to an 800 credit score, and some decent capital on hand, which I think would be a good fit for a program like that, because then we don't have to deal with that whole income verification as such, but we got the other elements that I think would make for a good loan.
yes. And I always say that the mortgage qualification process is like a tripod. You have your income, assets, and your equity. So basically, the income piece might be low, and they decided that the cash flow, the property, is the income piece for the ability to repay. And if you have credit, just like you said, your credit, and then you have assets, that's kind of what they want. They want you to have cash to close, but also reserves for your other properties you may have. And if you have those pieces, it's a pretty easy standard loan.
Would you say, what about a person who's sitting there maybe with a lot of equity in their house, where they've got a lot of room, they could come in and maybe take out a second on there? Is it smarter to go and pull out from a second for somebody like that, or is it better to go just with a whole different a loan program?
Well, I also joke that the answer to every mortgage question is it depends. So it depends on your personal financial situation. Have your other consumer debt been paid down? But just look at on a standard equity line of credit, it's 9-10% variable. Can you stomach that? Is it because 9-10% versus 6-7% fixed? So those are the qualifiers that you have to ask yourself. Yeah, you can tap your equity, your second home equity, but ultimately there's a cost for that.
Yeah. So it's it's probably a little bit higher debt if you go into your equity versus going into a whole new product like that.
I think if you have no other source of capital, see at that another line of questioning, or line of thinking rather, it's like equity is just sitting there. Like, you can't use it. Why not tap it and invest it? At least have a rate of return. As long as the rate of return is greater than what you're paying interest,
yeah,
you kind of have to really think of it that way.
Yeah. So if you're sitting at 9 to 10%, but you could pull out at that 9 to 10% and get back 15, then do it, right? I mean, because you're going to be net positive versus going the other way. But 9 to 10, when you come down to it, you got to make sure that you can get to that 9% or over that 9 to 10% return if you're tapping into that equity.
That's true.
So, yeah. So in terms of, your overall strategy when somebody comes to you, what kind of advice do you give them when they're out there looking at their vacation properties, wanting to get a deal done? On the lending side, what kind of advice do you give to them to make sure that they're going to set themselves up with the lowest risk and the highest chances of success?
Well, it all starts with, what are you looking to accomplish? It's like, what is your overall goal? It's like, well, I have this money sitting here in a savings account. I want to invest it to get a better rate of return. So you always start with, what do they want to accomplish goals wise? And granted, I'm not a financial planner or anything like that. I do mortgages, but it's a tool to accomplish your financial goals. So like I said, I look at based off the money you have and the credit you have, here's the maximum you qualify for. As I'm not saying you want the maximum, but here's what you do qualify for. And then you say, well, if you get this is what your payment will be. Can you rent it for that or more? So that's always the question. Can you cover that debt and then maybe raise rents and lower expenses to get a cash flow? And that's, what every investor should do that math to see if they can buy it low enough, or buy a multifamily so that it has enough cash flow to make sense.
Yeah. And so when you're talking about these loans aren't just for like a short-term vacation rental. This is for investors that can come in and buy even long-term. Maybe if they're going to do some long-term rental or like you said, maybe have some multiple units up to a specific threshold. They can use this type of financing.
And that's what that's primarily for. I've only had a handful that want to buy from a short-term rental and need the Air DNA information. Most of them are just standard long-term rentals. And I really wish mom and pop investors would buy them more.
Hey, everybody. I hope you're enjoying this episode of the Vacation Property Seekers podcast. I want to let you know about one question that I get all the time. And that's, how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that, or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertyexpertnetwork.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertyexpertnetwork.com. Yeah. What do you think are some of the bigger mistakes or some of the incorrect assumptions that people make when they're going through this process?
I think they do understand how much 25% down plus closing costs and prepaids. So that's the key too. So as brokers, we go what's called borrower paid. So the rate sheets are just, there's no fat in there. There's no overage in the interest rate. It's basically your standard interest rate plus we charge origination. Usually that's about 2% or so that we charge. And brokers are far more transparent that way. It's like, this is what we're charging versus some other hidden fee. And that gets your interest rate down as low as we can. So is it to understand what the costs are today and also the carrying costs. And yes, it's a risk, but there's a reward as well. But to understand what all the costs are.
Yeah. Well, I think a lot of, especially in the vacation home market, so a lot of people come in and think, I'm just going to buy this vacation home. I'll throw up a shingle and be in business, and I'm just going to take wheelbarrows of money to the bank. But they're not thinking about, the management costs. They're not thinking about all the costs that go into maintaining and operating that property. Same thing on the financing side, where they're not really getting in true touch with their numbers. And I always tell people, if you're going to be a successful investor, especially in short-term vacation rentals, you got to know your numbers. You got to make sure that you know what your pro forma is going to look like. You got to get your projections as close as they can be. If you're looking at your income, err on the low side. Make sure that you're being conservative. If you're going to look at your expenses, err on the high side. Make sure you're going to be conservative and then see what you got at the end of the day. But the same things would hold true for what you're doing. Make sure that you know what you're going to be paying for, know what those expenses are, know what it's going to cost you for this loan product also, so you know what you're getting into.
Absolutely. I just thought of when you were talking, know the environment, because there's certain municipalities don't love short-term rentals. You have to be very clear on what the rules are. Is it, a certain number of days of stay? And some cities are just very anti short-term rental. So you have to be do your due diligence on that as well, not just the numbers.
Yeah, no, I tell people that's where you should start. If you're going to look at a property, if you're not figuring out if it's legal or illegal to operate in a city, I mean, that's your first step. I mean, the worst thing you could do is get into a city and start putting stuff under contract or even getting to a closing and going, oh, you can't do short-term vacation rentals here.
That's true.
And, I tell people even to go into the books and make sure, see if there's any kind of city council proposals to limit it, or, because you can go in and look at dockets to see what they've been talking about on a city level also, just to make sure that it's not something that might be legal right now, but in 4 months is illegal. Or maybe you can get grandfathered too. You just got to do the due diligence, do the research to make sure whatever you're doing is going to work. Otherwise, you could be sitting there with an asset that you might not be able to, you might have to make it a long-term rental.
That's true.
Yeah. Yeah. What about, I want to talk a little bit more about the closing costs. So you were talking about overall kind of the process and the closing costs associated. When you look at a traditional lending product versus an investor lending product, is there a big difference in those closing costs?
Not necessarily. So you have here in Florida, where I'm at, you have your standard, your title insurance, and you have your doc stamps, because Florida has no state income tax. So that's how they make money through deed stamps, and 0.2% and 0.35% of the loan amount that the state gets. So those are standard. The only thing that we can control as lenders is your box A fees. So we can go back and forth. So basically, you either pay our commission and your interest rate through a higher rate, or versus upfront origination. So traditionally with owner-occupied property, there's, I'm going to say, like a spread that can be hidden. So on my box A, it can look like I'm not charging you anything, but your rate is higher. So I charge you a higher rate, and that's how our comp is paid. Or if you have cash, we can flip what's called borrower paid, and only brokers can do this. So we charge our origination directly, and you get a raw rate sheet. Even if we go what's called lender paid, where it's in the interest rate, we have to disclose what we make. Your other IMBs and things like that don't have to tell you, because they were at the table when all the rules were made, and brokers kind of got screwed. So, which I like, because I like being transparent. Look, this is what we make, and you'd be far more transparent that way. That's why I believe that we have a saying that brokers are better. So for your lending needs. And there was just a study done by UWM that last borrowers that went with a broker saved over $10,000 more versus using an actual retail lender. So it's definitely worth, definitely shop around. Obviously, you work with somebody that you trust, but take a look at your local mortgage broker in your town.
Yeah. Are they doing these loans on your typical like 15, 20, 30 year, or are they more short-term type loans?
No, they're all amortized for 30 years. I believe that's the only choice. Now that I think about it, because I was looking the other day on those, but I believe, so they're amortized for 30. Of course, there's no prepayment penalties, but you can choose to add one, because it falls under the category of non-qualified mortgage or non-QM. Like a qualified mortgage is what most mortgages are, no prepayment penalties, have a rate and fees cap, things like that. But with a short-term rental, if you're going to own it for a long time, you can choose to put like a 2-3 year prepay and get your rate down and cost down even more.
Yeah. Well, what about, so the interest rates? I know that, we're just, for context, we're sitting here in September 2024. Interest rates, of course, increased significantly when they were trying to get the inflation in line for us, which I believe they've done. And now they're talking about having some reductions in interest rates. What about those people who are sitting out there thinking, well, I'm going to wait till interest rates go down more, or go down more and go down more? When should people really go, you know what, it's time just to get in? Or should they get in now and go, you know what, I can always refi if I need to?
Of course, being in the mortgage business, it's of course I want to tell you to buy, of course. But when you look at data, because everybody wants to believe that 2008 is going to happen again, and it won't, because those set of circumstances aren't the same. So if you look at the inventory in the country in 2006, the highest ever was over 4 million units. And then you have my generation, Generation X, was coming through in their early 30s. The median in-person home buyer is 33. You had the lowest number of people and the most number of houses. Now we're inverted. So you have your millennials and Gen Z that are looking for homes. And then there was like a desert of building after 2008 for like 15 years. So we're still 4 million units short of basic demand. I mean, if 8-9% interest rates didn't crash the market, what will? And that's what I try and and show them what the data is. So I have, graphs that I do in my buyer presentations. As I look, and there is a cost of waiting. And that's one of the reports that I run. And so if it's missed out appreciation, missed out amortization by making your mortgage payment. And another big thing too, I don't know if you saw that article in the Tampa Bay Times about a number of corporate owned single family rentals. It's kind of shocking. And I posted on my Facebook page where, like your Celebration Homes and your corporate owned people are buying up single family rentals. So you have a lot of competition. So what's going to happen if rates come down more and more, you're going to have even more competition from single family home buyers and other corporate entities buying. So if the numbers make sense, I mean, don't, extend yourself, but there is a little benefit to waiting, because what are you waiting for? Like what's the differential that you're going to get? Like, you're not going to get this 2008 level crash where you didn't buy it on the cheap. It's not going to happen, guys. And there's, don't take it from me, go look, you have to look at Housing Wire, Logomoto Shami, and those guys smarter than I am. It's just not in the cards. So if you're looking for a house to buy, personally, look at that, but also there's such a inventory shortage. Buying an investment property smart too.
Yeah. And, and real estate is very cyclical. You've been through like you said, I'm a Gen Xer myself. So, I've been through multiple cycles. Of course, this last cycle has been one of the longer cycles that I've seen. We had, like you said, that 08, 09 kind of bank crisis where everything kind of hit the fan. I remember going out during those times, and I remember going to single family residential subdivisions where I'd got called in by the bank to go out and say, what do we have out there now? And, we'd go out and the developer would be like, well, they had the streets in, they did the infrastructure in, they did the hydrants in, but no homes on the property. So they've got, these roads in there, but they're literally throwing up fences around the subdivision and putting cows out there to graze. And said, well, it's going to be grazing cows until the market turns back around and we start building again. Of course, back then, Denver, we rebounded pretty quickly. I think we were thinking it was going to be a 10-year cycle before people started building again, but they were building again within 2 out here. But the point is, you just never know. You never know where you're at in that cycle. You sure as heck can't predict the cycle. But I agree with you. I don't think we're going to have that 08, 09. The inventory is not out there. And again, when these interest rates are going to start going down, which they are, they're already talking about lowering them down a little bit. It's going to just create more demand. People going out and going, well, I better go buy now because the rates are finally coming back down. And then you're going to have the institutional folks on top of it buying. So there's going to be a lot of competition for a little bit of inventory.
That's true. And another key point too is that what the Fed does for short-term rates has some effect on long-term rates. It's ultimately market-based. So there's a scenario I've seen that even if they cut, rates can start going up because a lot of those have already been priced into our rate sheets already, like on the secondary market. So if they don't cut as much because they don't know they're going to do 25 or 50 basis points, there's a scenario rates go up. So I always say, look, if the numbers make sense today, I just did a lot of VA interest rate reduction loans, for some of my VA borrowers, so we had incentives. So if the numbers make sense today, do it. Like waiting doesn't really benefit you that much.
Yeah. Well, I'd also say, I'd give people a little bit of caution, especially with the short-term vacation rentals. We're talking about somebody coming out and doing these income verifications and seeing what kind of income, could be developed from the property or could be generated from a property. But do that work yourself. Be somebody who makes sure you go in and you look at the AirDNA data. You go into each neighborhood and look at those neighborhoods to see what everything's renting for. You go in and figure out, I love getting 3 years of historical operating information. Give me 3 years of expenses on utilities. Give me 3 years of expenses on water. Give me 3 years. If I can get that data and come up with my own pro formas, again, if you've got somebody who's just looking at income, but they're not looking at net operating income, get into it with that net operating income. Make sure that NOI at the end of the day is going to cover your debt service, plus make you some money.
Yeah, that's fantastic advice. If you could do that at 3 years and that kind of analysis, that'll definitely help you out and make sure you anticipate every scenario.
Yeah. Well, so a lot of folks, when they're buying their vacation homes, they operate on emotion. Like they fall in love with the market or they fall in love with the property or something they want. And they go, well, I'm just going to do this and I'll rent it. I won't even have to pay for it. But they don't really do that deep analysis to go, well, how much does that equate to? Well, how much am I going to be in the property? What's the management of this going to cost? What's it going to cost to maintain the property? A lot of that work doesn't get done. Then they get an emotional buy and then they're I don't want to say they're upside down, but they're coming to the table with more cash than they think they're going to because they haven't done the work.
Right. Yeah, absolutely. That's why I when I do an analysis, I try and do a worst case scenario. So when it's like, here's the cash to close, I always overestimate rather than lowball. That way, so any estimates that I'm in your analysis picture are accurate, at least within a good ballpark range. So when you look at because we don't look at utilities or anything of that nature, that's another huge expense. That's just the mortgage industry doesn't look at that stuff. They just, I don't know why. The guidelines are what they are. They look at what your debt service. They look at basically your installment debt and your credit card debt, minimum payments, and then do look at gross income. So, but yeah, so make sure all those expenses and talk to join a real estate investment club, for sure. There's a lot of good ones. You can talk to those people that are doing what you want to do. So a mastermind group is definitely a great idea.
I tell that, it's silly that you don't, if you're going to get into this market, if you're going to really get into investing, understand it, get around people who are doing it, get information coming in that are going to help you get these conservative estimates. That's the one thing you said that I like too. It's like, I like to underestimate my income and overestimate my expenses, and then look at the markets and go, well, okay, how can we outperform in these markets now? We've got this data. I think this is the worst case scenario. And that's what I like to buy on. I'll buy on the worst case scenario because, that's when you're going to go in, you're going to get your better deals, you're going to negotiate. And then when you come out on the other side, you're going to have you're going to reduce risk and have a lot more chances for actually succeeding.
Great advice. Absolutely. Yeah, so it's just be conservative in your estimates. And the people that have bought your first term rentals, I always caution them that way too. It's like here's what the expenses are going to be, worst case scenario. And I always implore them to do a good analysis. And I always give them the market data about, like, should I buy an investment property? It's like, well, if you want to be a landlord and understand what that means, do your numbers and understand that there's ongoing costs after you buy.
Yeah. I mean, I want people to be able to find you because I think you're a wealth of knowledge. You have very good collaboration with people who are looking at this type of investment vehicle. And I think it's a great investment vehicle. I mean, just to have this option is phenomenal for an investor out there who's sitting there maybe thinking they couldn't get into an investment property. But what do they need to do to find out more about you and your lending products?
No, so they can just go to tcmortgage.com or just search my name on Google. I create content on YouTube and Instagram, but YouTube primarily. Trying to create more and more content about short-term rentals and investment, real estate investing in general, along other things. So that's where you can find me.
Good. And I'll put that into the show notes also. But one last question. So that person sitting there, getting into the market, getting into short-term vacation rentals, if you could give them your one piece of best advice for them starting out, what would that be?
Know your numbers. Look at this. If you're going to finance and you only have a certain amount of capital, to make sure you maximize that capital so you're not spending too much of it. So understand what the numbers are. How can we get your cash to close as little as possible? Because there's still a big inventory shortage. And I harken back to that Tampa Bay Times article. Like when I first saw that, and it has an interactive map. It has like a dot map all over your city about corporate owned things. They're buying up the neighborhood. So it's your duty to go do this, guys. For you and your family, go out there and compete with these guys. Buy more property than they do. Like that's what you need to do. Like I would rather have a lot of mom and pop investors and vacation renters versus these corporate entities that are out of state.
Yeah, you're speaking my love language right now. Know thy numbers. Know thy numbers. Well, Emmett, thank you for coming on the show today. That's great. Appreciate it. Wealth of knowledge, very informative. And hopefully it gives you folks out there hope on if you're sitting there going, I don't know if I can do this. I don't know if I can actually get into it, or how do I get into it? Especially the financing side. There are options for you sitting out there available for you. Take advantage of them. So Emmett, thank you for coming on the show today.
Thank you for having me.
All right. Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertyexpertnetwork.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets Podcast.